It is my experience that nobody, or very few people, have a consistent approach to doing that. And it's the lack of consistency, rather than anything else, that causes most investors' emotions to rise and fall with the ebb and flow of the tide of the market. What I'm going to do today is show you one consistent approach. It is not the approach. It is not the only approach. There are many other ways of making a fortune in the stock market. The way that I invest in the stock market has worked for me, and I'd like to share that approach with you. Okay, so before I get started, a disclaimer. I don't know your personal financial circumstances. And because I don't know your financial circumstances, because I don't know whether the stock that I mention is right or wrong for you, that is why before you engage in any securities transactions, you should seek and take personal financial advice. All right, so what I'm going to do today is I'm going to talk a little bit about how I invest at Montgomery Investment Management. For those of you who are interested in investing yourself, I'm going to be talking about a product that we've created that we use in Montgomery Investment Management, you can use as well, called Skaffold. I'm going to show you how I find great value opportunities. I'm going to explain to you how I find companies that are cheap. And also, for those of you who haven't been to my presentation before, I'm going to actually explain how I go about valuing a company and how Skaffold does it. I'm going to show you how we evaluate a company and its prospects, and we'll talk a lot about that. And if I get time, and I'm hoping we'll get time, we'll talk about what's cheap right now. And I think I have 11 stocks that have come up on a scan that I ran today, just before I arrived here, to see whether anything met our criteria today. Before we talk about actually picking stocks, I need to share with you how I think about investing. And this might be very different to the way you think about investing and the way you think about the stock market. Remember, it's not the only way, but it's the way I do it. So what we do is we think about businesses. There's a terrific quote that Warren Buffett once said. He said, if you're not prepared to own the whole business for 10 years, don't own a little piece of it for 10 minutes. And that got me thinking, well, I have to start approaching investing in stocks the way I would invest, the way Gresham, for example, might buy an unlisted business, or the way TPG, Texas Pacific Group, might go and buy or acquire an unlisted company. We've got to approach investing in stocks the same way we might approach buying a Baker's Delight franchise. What are the sorts of things that we would look for if we're going to make that acquisition? Interestingly, if you're a business owner, then the measurements that you use and the things that you look at to see whether or not that business is going well is very different to the way most people in the stock market view whether or not their business is going well. You see, if you own your own business, you're going to be looking at the profits, you're going to be looking at cash flow, you're going to be looking at how much you have to reinvest into that business, you're going to be looking at whether competitors are setting up next door, you're having a look at whether council's going to increase their rates, you're having a look at what the rules are regarding putting tables and chairs out on the footpath. You're looking at things that relate to the performance and prospects of the business. But in the stock market, what a lot of people do is they just ask themselves, is this stock going up? They're very different things. One is thinking about the business and one is thinking about stocks. One is treating investing as a business proposition and one is treating investing as a casino, a gambling operation. Okay, the other thing is we look at value, not price. So the stock market isn't turned on at our desk. We're not looking at stocks. We're not looking at where the market is today. I couldn't tell you where it is right now. So we don't look at values first. See those dots? All of those dots are companies listed on the Australian Stock Exchange. The ones on the right-hand side are A1 quality. They're the best quality companies listed. The ones on the far left-hand side are C5 companies. They're the worst possible quality companies. They've got the highest probability of going bankrupt in the next 2 years. The ones on the left-hand side. The ones on the right-hand side have the lowest probability of going bankrupt. The ones above that horizontal line that you can see there's a thin dotted horizontal line, they're cheaper than their intrinsic value. The ones below are expensive compared to their intrinsic value. They've got a negative margin of safety. The ones at the top have a positive margin of safety. And those blue circles that you can see around those dots, well, I typed in the companies in our portfolio to see where they actually were in the universe. That's where they were. Now, most people focus just on the value. They just want to buy cheap stocks. My suggestion to you is that we don't focus on cheap stocks, we focus on quality companies that happen to be cheap in the market. Okay, so look at quality first. Look for a demonstrated track record. Now, that's a very conservative thing to say. If you're a conservative investor and you don't want to take a lot of risk, then I think you need to find businesses that have a demonstrated track record. Now, there's sometimes a bit of confusion about new floats, because I've invested in new floats. I've invested in IPOs, and we've done reasonably well out of them. How can we invest in new floats when we're looking for a demonstrated track record? Well, we tend to invest in companies that have been in existence for many years before they floated. So we're interested in good quality companies with a demonstrated track record. Then we look at whether or not they're cheap. Then we're interested in finding out whether or not they're actually good value. And only when there's a big discount to our estimate of intrinsic value do we even entertain the prospect of buying. Okay, so how do we go about finding great value? Well, first I mentioned good quality businesses. Now, to summarise, what we do is we take about 37 ratios, point in time ratios, and longitudinally observed ratios. So we look at the change in those performance figures of a company over time. There's 37 of them. And what we do is we then collate all the companies into a rating. We give them a score from A1, or Skaffold does, from A1 all the way down to C5. And our universe at Montgomery Investment Management is A1s, A2s, A3s, B1s and B2s. Now what does that mean? Well, essentially we're looking for companies that have little or no debt. I'm going to show you a list of 11 of them that have no debt today, that also appear to be cheap. We're looking for little or no debt, and there's some reasons why we look for little or no debt. It's very simple. If you have two companies, one with no debt and one with lots of debt, both of them have the same revenue and the same EBITDA, or earnings before interest, tax, depreciation and amortisation. If we get a 10% decline in revenue or a 10% decline at the EBITDA level, then the company with lots of debt, its share price is going to fall a lot more, and it always does, it's just a trick of arithmetic, it's going to fall a lot more than the company that has no debt. The reason that is because companies that have a lot of debt, because of the multiple of book value that you're paying, are always more expensive on the market than a company with no debt, even if they've got the same PE ratio. The second thing that we're looking for is a company with high rates of return on equity. And there's a number of reasons why we look for companies with high rates of return on equity. One of them is that over long periods of time, if you buy and sell your shares on the same price to earnings ratio, then you'll find that your return over longer periods of time will basically mimic the return on equity rate of that company. So if you buy a company on a PE ratio of 10 and you sell it on a PE ratio of 10, and it generates a 20% return on equity and it pays none of its earnings out as a dividend, your internal rate of return is going to be 20%, exactly the same as the return on equity of the company. So the objective is to buy businesses with high rates of return on equity. Why? Because we want to generate the highest possible returns. So if we can find a business that's trading at a cheap price and it's generating a high rate of return on its equity, then the possibility of us also generating a higher return goes up. It's not guaranteed. The share price could still go down. We don't forecast share prices, but we know that the possibility of us generating high returns goes up meaningfully if we do that. And we're looking for a discount to intrinsic value.